Calgary and see so many familiar faces and friends. I've been coming here with the Eurasia Group since 2006, and with UBS Warburg back in the late 90s as well. Made the rounds as well, and I'm out here quite a bit, as Reynolds said. Thank you for the very kind introduction. And I do faithfully swear and execute the promise to give as best oil price forecast I can for going forward. I really was impressed with that. That was really good. So I picked 2 oil futures. We could talk about a dozen or 15, but let's pick 2 and let's try and do it in 20 minutes and give you some ideas to think about where we could go with oil this year and what are the key drivers. No one has a crystal ball, but we can look at signposts that will tell us how our market's evolving. Are they evolving back towards the conditions that we saw 2010 to 2014? Is this more like 1986, or is it something entirely new? I want to address some of those questions here today. As Reynolds suggested, Eurasia Group, we're a political science firm, so our approach to looking at energy markets is on the above ground side, looking at the economics and politics and strategic issues in the market, and that's what I'm here to talk about today. And I leave the below ground side to the many experts in this room for another time. So the 3 things I want to cover today briefly: OPEC strategy, the resilience of North American supply in the context of these lower oil prices, and what's going to happen on the demand side, because there's some uncertainty there as well, especially in Asia. And then we can try to tie that together a little bit at the end and where we're headed. If I could do it over again, I would have said Alberta's 2 futures $50 or $75 a barrel. But you know, when you set these things 6 months in advance, that's sometimes what happens. 100 is not impossible, but perhaps not likely this year. Of course, we had a $100 a barrel average Brent price in that 2010 to 2014 period. And this is a bit of a complicated slide, but if you step back, it's not too hard to understand. The red line shows the growth in U.S. oil production from about 5.5 million barrels a day to 9 million barrels a day. By far the biggest source of oil supply growth anywhere in the world during that time. The bars show the level of geopolitical disruption within OPEC countries. Security problems, sanctions, civil conflict in countries like Libya, Iran, Nigeria, Iraq, etc. And you can see that those 2 things balance each other out pretty well, particularly in 2012 and 2013. So we had a balanced market. Growth in the U.S., but disruption and underproduction in some of the OPEC countries. And that kept prices at a reasonably high level.